Hi guys, welcome back to TradeX Pro. In our previous episode, we explored the 5 key types of candlesticks: the momentum candle, shrinking candle, long wick candle, indecision candle, and inside bar candle. We also explore how they can help you understand market behavior and trader sentiment. Today we're diving into the world of candlestick patterns, which are unique formations created by one or more candlesticks on a chart. These patterns offer valuable insights into market trends and potential price movements. We'll explore some of the most popular patterns, explain how to interpret them, and show you how to use them to make smarter trading decisions. By the end of this episode, you'll be equipped with the knowledge to spot these patterns and enhance your trading strategy. Let's get started. Before we begin, let's clarify some key terms related to candlestick patterns and chart patterns. Candlestick patterns generally focus on short-term price action and usually consist of 1 to 3 candles. These patterns are designed to capture quick shifts in market sentiment and potential price movements over a short period. Chart patterns, on the other hand, involve a broader view of price action and can span over 10 or more candles. They form distinct geometric shapes on the chart, which makes them easier to remember and identify. These shapes reflect longer-term trends and potential reversals, providing valuable insights into market behavior over extended periods. For today's episode, we'll concentrate on candlestick patterns. Understanding these will enhance your ability to interpret short-term market behavior and make informed trading decisions. Let's dive in. Candlestick patterns are often categorized by their market direction and formation structure, and each is given a specific name. To make things simpler, I group these patterns based on the number of candles they involve: single candle, 2 candle, and multi-candle patterns. While many of these patterns are recognizable by their shapes, memorizing every single one can be overwhelming. Instead, focusing on the underlying principles and concepts behind these patterns will help you apply them more effectively in your trading strategy. Today, I've selected 9 of the most popular candlestick patterns used by investors. These patterns are not only easy to remember but also have a high trading accuracy, meaning they offer a strong chance of successful predictions. We'll explore each pattern in detail and provide plenty of examples to illustrate their application. To make things clear, we'll number them from 1 to 9 as follows. We'll start with patterns number 1 to 3, doji, hammer, and shooting star. In fact, we've already covered these patterns in detail in our previous episode. The doji, in particular, which is also known as the indecision candle, represents a moment of market uncertainty. It features a very small body with either short or long wicks, indicating that neither buyers nor sellers were able to gain control during the trading period. This pattern suggests a pause or potential reversal in the current trend, highlighting the market's indecision about its next move. Hammer and shooting star are examples of the long wick candle. The hammer appears at the end of a downtrend and signals potential buying pressure. It has a small body near the top of the candle with a long lower wick, indicating that sellers pushed the price significantly lower during the period, but buyers ultimately drove the price back up. This pattern often forms near a support level, suggesting that buying pressure could lead to a reversal or halt in the downtrend. On the other hand, the shooting star appears at the end of an uptrend and indicates potential selling pressure. It features a small body near the bottom of the candle with a long upper wick, reflecting that buyers pushed the price significantly higher, but sellers managed to pull it back down. This pattern commonly forms near a resistance level, suggesting that selling pressure could lead to a reversal or pause in the uptrend. Let's look at some examples where all 3 patterns appear on the same chart. On your left, the price falls sharply and then reverses upward, establishing a support level. When the price returns to this level, it initially shows indecision, represented by a doji. This indicates that neither buyers nor sellers are able to gain control at this point. After this period of uncertainty, the market dynamics shift and the price starts to rise. After a brief rise, the price hits a major resistance level, marked by a shooting star with a long upper wick. This pattern indicates that although buyers pushed the price higher, sellers eventually gained control and drove it back down. Consequently, the price begins to reverse and move downward, confirming the bearish signal. The price then retraces to the support level twice more. On the final touch, it forms a hammer with a long lower wick. This pattern shows that while the price initially dropped, buyers stepped in and pushed it back up, signaling potential buying pressure and a possible reversal. Please note that the color of these patterns is less important than their shape. The key is the formation of the pattern itself, rather than its color, which provides the insight into market behavior and potential reversals. Next, we will explore the three white soldiers pattern. This pattern consists of 3 consecutive bullish candles, each opening within the body of the previous candle and closing higher. The term white refers to the traditional use of colors in candlestick charting, where a white or light-colored candle signifies a bullish period. Historically, a white candle represents a day where the closing price is higher than the opening price, highlighting the upward momentum driving the market. This pattern signals strong bullish momentum, characterized by 3 consecutive candles that indicate sustained buying pressure. The 3 white soldiers can appear in both bearish and bullish markets. In a downtrend, where the price is persistently falling, the formation of this pattern indicates a potential reversal and suggests the beginning of a new uptrend. In an uptrend, if the price experiences a minor pullback, but then forms the 3 white soldiers pattern, it indicates a strong likelihood that the price will continue moving higher. This pattern confirms sustained buying pressure and suggests that the previous upward momentum will persist despite the brief retracement. An example to the left highlights a trend reversal. Initially, the price falls gradually, but the formation of the 3 white soldiers at a support level indicates a shift in market momentum. This pattern suggests that the downtrend may be reversing, paving the way for a potential uptrend. Similarly, on the right, the price experiences a sharp decline with a significant gap down. However, the appearance of a long wick candle followed by the 3 white soldiers pattern signals strong buying interest and prevents the price from falling further. This combination suggests a potential reversal and the start of a new uptrend. In an uptrend, if the price pulls back and then forms the 3 white soldiers pattern, it signals that the upward trend is likely to continue. The pattern confirms that buying pressure remains strong and the uptrend is expected to persist. Another example. Despite a strong pullback, the trend can still continue to rise after forming the 3 white soldiers pattern, especially when the candles have relatively large bodies. This indicates that the upward momentum remains strong and the trend is likely to advance. The 5th candlestick pattern we're covering today is the 3 black crows. This pattern consists of 3 consecutive bearish candles, each opening within the body of the previous candle and closing lower. It demonstrates that the market has shifted from bullish to bearish sentiment, with each successive candle showing deeper losses. The term black in this pattern traditionally denotes a bearish period in candlestick charting, where a black or dark-colored candle signifies a closing price lower than the opening price, reflecting downward momentum and selling pressure. Similar to the 3 white soldiers, the 3 black crows is its opposite. This pattern illustrates sustained selling pressure, indicating strong bearish sentiment in both uptrends and downtrends. In an uptrend, where the price has been steadily rising, the appearance of the 3 black crows pattern suggests a potential shift in market sentiment. This pattern near or at a resistance level often signals a higher probability of a trend reversal, indicating that the price may soon experience a downturn. In contrast, during a downtrend, the 3 black crows pattern can negate minor pullbacks and strengthen the bearish momentum, indicating that the selling pressure remains strong and the downtrend is likely to continue. In the real chart example, the price initially rises and then enters a consolidation period. This period is broken by the 3 black crows, confirming the downward reversal. Each of these bearish candles opens within the previous candle's body and closes lower, signaling sustained selling pressure. This pattern indicates a strong shift in market sentiment from bullish to bearish, suggesting further downward movement is likely. On the right, a similar situation unfolds. Initially, there is a strong rise in price. Then, the trend abruptly switches, marked by the appearance of the three black crows. This signals the start of a sustained downtrend. After this pattern emerges, traders often anticipate continued bearish momentum. The three black crows can also signal the continuation of an existing trend. For instance, in the example to the left, the price experiences a steady decline followed by a minor retracement. This brief pullback is countered by the formation of the three black crows, which confirms that the downward trend is likely to advance. Similarly, on the right, the price falls sharply but undergoes a significant pullback. Despite this temporary rise, the downtrend persists. Two instances of the three black crows appeared during this period, each effectively halting the pullbacks and reinforcing the continuation of the downward movement. Moving on to the next candlestick pattern. The bullish engulfing. This powerful pattern is a key indicator of a potential reversal from a downtrend to an uptrend. It signals a shift in market sentiment, suggesting that buying pressure is overcoming selling pressure and a reversal may be underway. The bullish engulfing pattern consists of two candlesticks. It starts with a small bearish candle followed by a larger bullish candle. The second candle opens lower than the close of the first, reflecting initial bearish sentiment. However, it then completely engulfs the body of the preceding bearish candle and closes above its high. This pattern indicates a strong shift in momentum, with buying pressure overcoming the previous selling pressure and signaling a potential reversal from a downtrend to an uptrend. In lower time frames, such as those seen in stock markets, or in continuous markets like Forex and cryptocurrency, the opening price of the second candle might be the same as the closing price of the first. Even in such cases, this formation is still considered a bullish engulfing pattern. The key feature remains that the second candle fully engulfs the body of the first, signaling a strong shift in momentum and a potential reversal to an uptrend. Similar to the three white soldiers pattern, the bullish engulfing can signal both trend reversals and trend continuations. In a downtrend, if a strong bullish candle appears and fully engulfs the body of the preceding bearish candle, it suggests a potential reversal. This formation indicates that buying pressure may be overcoming the previous selling pressure, signaling a shift towards an uptrend. In an uptrend, a pullback followed by the formation of a bullish engulfing pattern indicates that the upward momentum is likely to persist. This pattern signals that buying pressure is still strong, suggesting that the price will continue its upward trajectory. Two examples will help illustrate this concept. First, during a downtrend, the price declines steadily. When a large bullish candle appears, completely engulfing the body of the previous bearish candle, it forms a bullish engulfing pattern. This indicates a shift in momentum, leading to a reversal and an upward movement in price. Another example happens during an uptrend. The price climbs continuously but then undergoes a deep pullback. During this pullback, the price establishes a strong support level and doesn't fall any further. When the price revisits this support level, a bullish engulfing pattern appears, indicating strong buying pressure and prompting the price to rise again, continuing the original uptrend. Next, let's examine the bearish engulfing pattern. This pattern is the opposite of the bullish engulfing pattern. It consists of two candles. A smaller bullish candle followed by a larger bearish candle that completely engulfs the first. This indicates a strong shift in momentum, with selling pressure overwhelming buying pressure, suggesting a downtrend may be starting. An example on the left demonstrates the bearish engulfing pattern during an uptrend. Initially, the price rises strongly but then slows down with an indecision candle near the top. When a large red bearish candle engulfs the previous candle, it signals that sellers have taken control, leading to a trend reversal. The second candlestick in this bearish engulfing pattern also has a long upper wick, reinforcing the selling pressure. In a downtrend, in contrast, the bearish engulfing pattern confirms the continuation of the trend. As shown on the chart, the price initially declines and then experiences a brief period of hesitation. When a large red candle appears, engulfing the previous one, it confirms that the downward movement is resuming and the bearish trend is set to persist. The last two candlestick patterns are among my favorites. Let's start with the morning star. This pattern is made up of 3 candles. It starts with a large bearish candle, followed by a small-bodied candle of any color. An important aspect is that the second candle must have a gap from the first one, creating a noticeable separation. The third candle is a large bullish candle that also gaps away from the second candle and closes deeply into the body of the first bearish candle. This formation signals a potential reversal from a downtrend to an uptrend, indicating a shift in momentum with increasing buying pressure. You might wonder why this pattern is so effective. Here's why. The first large bearish candle shows strong pessimism in the market. The gap down to the second candle reinforces this sentiment. However, the small body of the second candle introduces uncertainty and hesitation, suggesting that the downward trend may not continue. Finally, the third candle's large bullish move, along with a significant gap up, signals a shift in control, with buying pressure taking over from the previous selling pressure. Again, the morning star pattern can be useful for both trend reversals and trend continuations. In a bearish market, the pattern signals that the downtrend is ending and a reversal to the upside may be imminent. Conversely, in a bullish market, the morning star confirms that the upward trend is likely to continue after a brief pause or pullback. Let's examine some examples. In a downtrend, both cases show the price falling and then reversing upward upon reaching the bottom. If you look closely, you'll notice a morning star pattern forming. In both instances, prices gap down and then gap back up, signaling a shift in market sentiment. Additionally, the long lower wick on the second candle in both examples illustrates buying pressure, helping to lift the price. Please note that the color of the second candle is not important in this context. In these examples, we'll see how the morning star pattern signals trend continuation. Initially, the price rises steadily but then undergoes a brief pullback. During this pullback, a series of 3 candles forms the morning star pattern. This pattern indicates the end of the downward movement and the price starts rising again. The strong bullish pressure is marked by gaps up and a large bullish third candle, signaling a reversal back to the upward trend. Please note that in both cases, the second candle in the pattern also has a long lower wick, increasing the likelihood of a trend reversal. Our last candlestick pattern is the evening star, which is the opposite of the morning star. It consists of 3 candles, a strong bullish candle, a small-bodied candle indicating market hesitation, and a significant bearish candle that closes well into the body of the first. This formation suggests waning buying pressure and increasing seller control, signaling a potential trend reversal to the downside. Similar to the morning star, the evening star can be used to identify both trend reversal and trend continuation scenarios. In an uptrend, the evening star appears after a period of rising prices, signaling a potential reversal. The price initially rises, but once the evening star pattern forms, it indicates a shift in momentum and a possible decline. Conversely, in a downtrend, the evening star can signal a brief pullback before the trend resumes. The price falls, experiences a short-term upward correction, and then continues its downward trajectory, with the evening star confirming the persistence of the bearish trend. Examples demonstrate an uptrend scenario. In both charts, the price consistently rises upward and then experiences a reversal at the peak. The formation of the evening star pattern signals the end of the bullish trend and a potential shift in momentum. As the evening star forms, it indicates that buying pressure is waning and sellers are starting to take control. The price may begin to decline, marking the beginning of a downtrend. In a downtrend, in contrast, the evening star can signify a temporary pullback before the downtrend resumes. The price initially falls, then experiences a brief upward correction, forming the evening star pattern. This pattern indicates that the pullback is ending and that the prevailing bearish trend is likely to continue. The appearance of the evening star reinforces the strength of the downtrend and suggests that sellers remain in control, leading to further declines in price. In summary, these 9 candlestick patterns demonstrate various signals of market sentiment and potential price movements. Many of these patterns exhibit similar behaviors and can be used interchangeably in various situations. They are applicable for both trend reversals and trend continuations, as they share the same underlying principles of market psychology and price action. Mastering these patterns allows traders to better interpret market signals, refine their trading strategies, and enhance their ability to predict and respond to changing market conditions. Thanks for joining us, and see you next time for more insights and analysis.